Sure. I think the challenge with that definition is that it almost kind of presupposes that you can't have any money, because if money is a commonly accepted medium of exchange, it's one of those things where anyone's overly stickler on that term is going to miss emerging trends in money, or maybe emphasize them less than they might otherwise would. And so I instead view money as more of like a spectrum, where I generally would prefer that three-part view of money. I think that's a more accurate way of actually assessing the moneyness of something. Because, for example, you can look at, say, art, like a Picasso painting, right? That's a store of value, right? But it's not liquid. It's not fungible. It's a rather poor form of money,
Yes.
as you know. But it's a store of value. It's a bare asset. You can hold the Picasso. You can self custody it. With Bitcoin, you have something that's a store of value, but then, unlike a Picasso, and then even more so than, say, stock and things like that. It's liquid, fungible, and a bare asset, self-custodiable. So it's basically designed in such a way that you can trade the store of value for other things rather easily. And so I think it has better characteristics of money than many other things. And so when you're looking at the moneyness of something, I mean, basically, like, Egyptian pounds and kroners are both kind of not very good stores of value. The kroner is historically better than the Egyptian pound in that regard, but they're both essentially melting ice cubes. In their jurisdictions, they're 10 out of 10 for a medium of exchange. When you go outside of their artificial monopoly, essentially their own country, they're like a 0 out of 10 or 1 out of 10 for medium of exchange. I mean, they're quite poor. And whereas something like gold or Bitcoin, there's no area that's really as dense as these areas are in terms of their usage as a medium of exchange, right? So you go to Egypt, every single person there practically accepts Egyptian pounds. Gold, it'll take a little bit more friction to get it off your hands, but it will, it's not rocket science to find a way to do that. And whereas Bitcoin and gold and things like that, even dollars when you're outside of the country, they have decent salability, but they're never going to be as dense as a local monopoly currency, right? So I think the challenge with that definition is that it only really applies once something has already matured as a money. And I think it's not a very useful definition when we're analyzing an emergent asset for its potential moneyness, initially as a store of value, but then also saying how can this actually be used as money. I think one thing we can do is you don't necessarily have to have a Boolean outcome, right? So something is not necessarily money or not money. It's property of moneyness. And if we,
Yes.
for example, if we rank countries or rank currencies by their moneyness, right? So let's say we take a given country's currency. It's a 10 out of 10 in that country, but it's like a 1 out of 10 in most other countries. Whereas something like Bitcoin is like maybe a 3 out of 10 in a bunch of different countries, right? So it doesn't have it as dense of an epicenter as any of those monies in their own kind of artificial monopoly, but it actually has a broader reach of salability, higher moneyness outside of that, kind of artificially enforced density. Another way to kind of phrase it is if you have like an arcade, and there's an arcade token, and that token enables you to play games, maybe get meals, like, one of those like adult arcades, like where there's like, it's not like a kiddie arcade, there's like a bowling, there's entertainment, casino chips, for example. Those are something that is like money-like in a very small area, but then once you leave that establishment, it's terrible money. And nation state money is essentially the same thing, but on a far grander scale. And so that's why I view that focusing on the medium of exchange asset capability is important, but we have to then separate, are we focusing on density in one area versus almost no density elsewhere? Or are we focusing something that's global and that doesn't have that density, but is still a global form of money in that sense? The way I would phrase it is that, so I agree with that, but I would say that the physical characteristics eventually dictate what the market does with it. For example, shells were money back when, tribes had similar levels of technology and basically nobody could cheat the system. But once someone comes and invents metal tools and, industrial revolution, anybody who's still trying to use shells as money is going to have a really bad time because there's other people that can then rapidly expand the supply of your money and you're going to get wrecked essentially. And so, properties eventually dictate market use. And so that's why you want to both take into account the properties of something, but then also identify, you look for market signals. Is this thing actually being used as money? Is the trend higher or lower? What is current relative value compared to money? And so, that's why a Picasso is just never going to be a very good form of money because even though it's a store of value, it's intrinsically rare, it's interesting, but it just lacks good properties to be any sort of medium of exchange any sort of fungibility, any sort of liquidity. Basically, it's not a saleable good. It's buying something in Picasso is a very challenging process. Getting it authenticated, finding a wealthy buyer, it's a very challenging process. And so I would essentially describe that money is basically a ranking of saleability of different goods, and properties heavily dictate what is in practice a very saleable money. And then it just becomes a matter of more and more market participants realizing its properties, testing its properties, seeing how those properties hold up, and then different technology trends over time can potentially break the saleability of some sort of monies. That's kind of been the history of commodity monies. That's why gold's kind of the last one standing. That's the one that we just don't know how to make more of at any sort of like rapid pace. Whereas shells, beads, furs, cattle, salt, we can make all these things pretty rapidly, and we can sharply change their stock to flow ratios. Whereas gold and to a lesser extent silver hold up a lot better in that regard. And so Bitcoin, I think, has the properties of being good money. And then in a market sense, as we discussed earlier, it's got pretty good saleability, especially when you look at it in a global sense. Well, mainly that it's long lasting, right? So it's very resistant to the elements. It's rather fungible liquid to a pretty high degree. And then unlike many other commodities, it has a very high stock to flow ratio, meaning that it's very hard to make more of it relative to the amount that we already have. So the supply inflation rate is rather stable compared to most other commodities. And shells also emerged on multiple continents as kind of early forms of proto money, as far as people can tell. And the difference was that once we achieved a certain level of technology, we rendered shells to be a poor form of money. Whereas gold is along with some other precious metals, but especially gold, is essentially the one commodity that we don't know how to increase at a rapid supply. NYDIG did a chart a year or two ago that showed gold over the past century, the estimated supply inflation rate of gold, above ground gold. And it was a narrow band between 1% and 2%, almost like clockwork for a century, averaging around 1.5% per year. And that basically is along with this, its high level of durability and resistance to corrosion and all that. That's part of why it has such a high stock to flow. That makes it pretty good properties of money. Really, the only shortcomings it has is that it's not very divisible, right? Even a small, tiny gold coin historically was, more than like a week's, days or weeks worth of wages. That's why silver was highly used for a long period of time, because it had better divisibility for everyday use. And then number two is that it's not very fast, right? If you want to do global commerce, once we invented telecommunication systems in the 1800s, basically the telephone, the telegraph, undersea cables. We started linking all of our ledgers together. Settling with gold is just a more time-consuming process, and it's also hard to assay it. It's hard to verify that something's actually gold. It's pretty easy to do in small amounts. I mean, a gold coin's useful and kind of comes at a premium because it's not very cost-effective to fake a gold coin. Whereas gold bars, you can do things with tungsten, you can wrap things around it, have similar density. It's a more costly process if you want to have a pretty high velocity, right? So you have to abstract it in some way. That's why you had gold-backed fiat currencies. And one of the advantages of Bitcoin, I mean, it does have some shortcomings relative to gold. I'm more confident that gold's going to be here 5,000 years from now than Bitcoin, right? If I had to pick between the two. But what essentially Bitcoin does is comes up with a very scarce liquid commodity with its own settlement layer, and has those similar properties. But unlike gold, it can actually move about the same speed as fiat. You can settle it globally in an hour. With a Lightning Network, you can settle it seconds on smaller amounts. And so that's kind of where its niche falls. One of the key innovations, or one of the key things that Bitcoin brings to the table, is that the actual bearer asset can move around quickly rather than just a claim on that asset. And I think one of the downsides, so I don't agree with anything you said, but the challenge is that when you have something that relies on abstraction in order to move around efficiently, the challenge there is that it's easy to break that promise, break that peg, break that redeemability. And that's what we saw happen with literally every jurisdiction in the world. That you had the system, and I've argued that it's essentially that speed mismatch between commerce and the underlying settlement that allowed for governments and banks to be able to arbitrage that speed difference and eventually be able to break it. And when they broke it, and they had these fiat-only systems, the fact that if you could just teleport gold around and between people like mentally, right? It'd be really hard for fiat currencies to develop because what is their possible advantage over gold? And instead, their advantage was they were this big interlinked global ledger that can move around, and gold couldn't keep up, and so gold got rendered to just being a savings asset, for the most part, and a still a saleable, global asset, but not that quick medium of exchange that you have with fiat. And I think what Bitcoin essentially does is it says, okay, here's something that moves at the speed of fiat, but has the scarcity of gold, at least in the supply inflation rate sense. And so you have, I think, a reasonable shot at something where people can actually hold on to the underlying. They can self-custody the underlying. They can move around the underlying globally without relying on that counterparty trust.